What's going on, everybody? Wanted to give you guys kind of a mid-year, where are we now, what's happening, what's focusing on from a national perspective. We're going to do a little bit more of a localized perspective here in the coming days, but we wanted to start first and foremost with where we are in a national perspective. There's a lot of debate going on right now. Has the housing, run that it's been over in the last couple of weeks and last couple of months, last couple of really years, is that really starting to come to an end? We're going to dispel and give you some information so that you can be better aimed to have all that information whenever you want, whenever you can use it, however you can use it, to best position you guys to give you the best information moving forward. So kind of let's talk about what's happening and where we are at right now. And the prevailing question of the last couple of weeks has been, is the housing bubble preparing to pop, or has it already popped? And why, yes, there are signs that the market might be cooling. These signs necessarily aren't the true prevailing story. That's kind of like the headline, and it's really buyer fatigue more than anything else that is causing a lot of these issues to bubble up to the surface right now. We're going to touch on all of that in a little bit. But there's a real reason right now that why the search term, when is the housing market going to crash, that is up over 2,000% just in the last month. And it's a lot of buyers looking to figure out, is this still a good time to potentially be buying a home and trying to arm themselves with the most amount of information that they possibly can. But here's a tip. You as the agent, they're still going to be looking for you to answer these questions. If you're a real estate agent right now, it's better to be arming yourself with the best data you possibly can, which is why we want to be able to do this here today for you. The other thing is, in people searching for and trying to find out those answers, all they're doing right now is they're adding to the hysteria and the confusion that exists in the marketplace right now. None of this is good, in the fact that if people have these concerns out there and they're putting it out in the universe and they're talking about it right now, they're putting it out and having these conversations, which is only adding to the dialogue of, is there a housing bubble and is there a housing crunch that's going to be coming? Yes, it's true. No market can stay up forever. The old adage of what goes up must come down certainly applies. But when we talk about the housing market, we have to be understanding what all the factors are that are going to go into it, and really all encompassing of what we're talking about. And we're going to talk about a lot of these things, and you're going to take a look and see some graphs here later that are going to really highlight and really show all that we're talking about here. So let's talk about what your role, as whether you're an agent or whether you're somebody who is really just trying to understand this. Your role is still to be a market thought leader in the industry. Your role is to be dependent upon the information that you can gather and that you can then disseminate out to folks who need to hear it. Your role should always want to be, I know the answers, let me help put those answers out in the marketplace right now. You have to understand what your clients are looking for right now. What clients are looking for in the market right now is probably vastly different than what it was 6 months ago. It's certainly radically different than what it was 18 months ago, but you have to understand what clients are looking for right now and how they're going to be positioning themselves moving forward. Always be looking to understand what information that you have and what information is still to be had that you need to fill in the gaps around when you move forward. These are the types of questions that you need to be asking yourself. When you're putting the puzzle piece together for either yourself or for a client, what is it that you have and what is it that you're still missing to be able to figure out what's going to go where and what is still missing for you? And what is the best way to communicate that piece of information? That is the best question that you can possibly be asking yourself right now. You've heard me say real estate agents and people in the real estate market right now have to be able to ask good and better questions. So you have to figure out what is the best way for you and your clients to be able to understand how you can help people, whether it's their needs in buying a house or selling a house, or just trying to figure out what is the best option for them to figure out where you want to go and how best you want to position yourself moving forward. Market to market, it is vitally important to understand that no one market is ever the same. No one city is ever going to be in the same type of market. Our market here in Boston is going to be radically different than the market in New York, the market in Chicago, the market in San Francisco, the market in Miami. It is critically important that you understand that even going from town to town, it might be radically different. Some towns right now are still in the middle of an inventory crunch. Other markets and other towns and cities have higher inventory levels. It is all dependent. No one area is ever going to be the same. And we live in a time and a place where you have to take the time and the steps to make sure that you understand that part as well. Here locally as well, New Hampshire and Massachusetts are completely different. Make the assumption that Massachusetts problems are New Hampshire problems are a huge, huge mistake. So you really have to understand the market that you're talking about is now going to be more dependent of another market, or I should say independent of another market, and more dependent upon you to understand how those towns and areas remarkably are different. If you specifically focus on a geographic diverse area, have an understanding how diverse that is from city to city and town to town or area to area. Zip codes and areas that are going to delineate things out are going to be more important now. You can't just say that you're an agent specifically focusing on one county. You're really almost going to have to be hyper local and understand what each market that you live in and work in, how those are different and how those are remarkably different from one to the other. It's an all understanding and all about how you disseminate that information out as well. So let's talk about disseminating that out and how those matter and what all that means over the course of time. If the headlines of the story are what get people's attention, it's important to understand why they are catching people's attention. So let's talk about where we are with those headlines and then break those down to give you the stories behind those headlines. The first one is, despite the hysteria and mania, the housing market continues to be strong and price appreciation will continue to improve. The second one is, this is definitely not the housing crunch and housing market of the early 2000s, as standards and credit availability has changed to create a totally and vastly different landscape than it was then as it is compared to now. And finally, housing fundamentals and economics all point to continued growth and run in terms of pricing and do not figure to be as bleak as the stories might appear. We talked about how most people are talking about and searching on Google for, is the housing run over or is there a housing bubble? That is all just a story that's being created out there right now. There seems to be no economic signs or no even fundamental signs from just a housing perspective about how those things are going to change. And we'll get into these as we move along here. The U.S. economy is still very much in recovery mode coming out of COVID-19. It looks like we're going to be in recovery mode for a little bit longer than people forecasted. That's definitely not changing anytime soon. Employers are still having a hard time trying to fill positions. Just go to any restaurant, go to any hotel, you'll see this to be the case right now. These employers are having a hard time filling these positions due to the economic stimulus package and recovery plans that continue to incentivize folks not to find full-time employment. Now, these are starting to wane as we will go into the end of the summer months, but these types of programs were put in at the height of the problem to try to be a stopgap measure. They weren't intended to be a full-on and almost full-time replacement, but unfortunately, that's what they've grown to be. As the economy has taken longer and longer to recover, these plans are still in place. They aren't necessarily a bad thing, and they were designed with the best intentions still in place. But as we get further and further and further and further away from the height of the pandemic, you have to wonder how much longer these things can be in place. The third part of the story, and this cannot be stressed enough, as it really is more or less an indictment of us as a economic entity unto itself, is that the pandemic most definitely 100% caused a lot of economic stability. But what it did more than anything is it highlighted and even amplified the problems that exist and the inequities that exist within the housing sector, and we'll touch on that in a few moments as well. The fourth thing, and this is probably the big takeaway here, is that homeowners who were able to withstand the pandemic from a financial standpoint had little to no financial stress through the pandemic. They were able to partake in the housing market with little to no regard on the pricing issues that came out of it, which has basically allowed more affluent buyers to take advantage of the housing inventory crunch that came about, meaning that folks who had little to no economic impact, if they were thinking about buying a home, were able to take advantage of the opportunities where others did not. And as I alluded to earlier, that's where we're talking about highlighting and amplifying the inequalities in the housing market. At the same point in time, millions of homeowners that lost income due to the shutdown fell way behind on their housing payments and are still running the risk of either eviction or housing foreclosure, and we'll touch on that in a few minutes. But a disproportionate number of these folks, especially renters, are people with low incomes and unfortunately are people of color. This is where we certainly still need some sort of government assistance to be furthered along to help to definitely not only solve the housing inequality that exists, but to be able to help and make sure that everybody is able to participate in the rising economy and the growing economy that will come out of the COVID-19 pandemic. So now let's take a look at what the experts are saying here, and let's go and take a look at Wall Street. The first one here is from Goldman Sachs. Strong demand for housing looks sustainable. Even before the pandemic, demographic tailwinds and historically low mortgage rates had pushed demand to high levels. Consumer surveys indicate that the housing buying intentions are now the highest in 20 years. Can't stress that enough. Mortgage lending standards have also remained fairly tight. We touched on that earlier. With demographic trends still strong, mortgage rates very low, housing affordability still very high, and household wealth as a share of income at the highest level in U.S. history, demand should remain strong. Okay, so that's just one opinion from Goldman Sachs. Let's go to the House of Morgan and talk to the folks at J.P. Morgan. Whether you are a home buyer, an investor, or both, now may be a good time to consider buying U.S. real estate for personal use or strategically within your portfolio. Home buyers, interest rates are still historically low, though they are inching up. Housing prices have spiked during the last 6 to 9 months, and we don't expect them to fall anytime soon. We believe they are more likely to keep rising. If you are looking to purchase a new home, conditions may be better than 12 months hence, especially if you are looking in the suburbs or the U.S. South. Investors, consider making an allocation to the U.S. housing sector. Since 2008, the shortage in construction of new homes has been so extreme that there is now a lack of homes available for sale. It will take time to reverse the supply shortage. We expect the current construction cycle already heating up to continue for years. We'll touch on that in a few minutes. Let's go to Morgan Stanley. Unlike 15 years ago, the euphoria in today's home prices comes down to the simple logic of supply and demand. We conclude that this time the sector is on a sustainably sturdy foundation. The robust demand of the highly challenged supply, along with tight mortgage lending standards, may continue to bode well for home prices. Higher interest rates and post-pandemic moves could slow the pace of appreciation, but the upward trajectory still remains very much on course. Finally, let's go to Merrill Lynch. There are reasons to believe that this is unlikely to be unusually long and strong housing expansion. Demand is very strong because the biggest demographic cohort in history is moving through the household formation and peak home buying stages of its life cycle. Coronavirus-related preference changes have also sharply boosted home buying demand. At the same time, supply is unusually tight with available homes for sale at record low levels. Double-digit price gains are already rationing the supply. So, in hindsight, let's put all this together and let's talk about what this means. In most markets, and I stress this, in most markets, housing is undervalued, and the gap between home buying power, meaning what people can afford to pay for a home, in sales price, meaning what the home price of the house is actually listed for or sells for, continues to show that there is possible expansion to the upside and further price growth expansion on the horizon. In layman's terms, in the simplest form of what all this means, it basically says that our home buying power compared to where home prices are right now is still disproportionate, meaning that our home buying power compared to where sales price is discontinued the other way. In 2008, it was the other way. People's home buying power wasn't as high as home prices were, but people were still able to get mortgages. Right now, the imbalance goes the other way. Again, not all markets are the same, and in some instances, this is not the case. So due diligence still has to be done, which is where you come in to be able to position yourself to know how to position your clients, whether they're buyers or sellers, and how best to be able to help them with whatever information that they possibly need. So let's take a look at where we are over the last couple of months, and let's put this into an understandable side of how everything flows together. Home sales bounced quickly from a mid-2000s pause. They followed a 26% drop in May, and existing home sales then were up 20% year over year on average from September 20th all the way through September 2021. So let's think about what that means, and we'll do a deeper dive into that. So home sales had historically kind of dropped from its mid-2000s pause after the housing crunch. There was a 26% drop in existing home sales in May of 2020. And that's to be expected. The whole economy was on pause. Housing prices or housing sales stopped. People weren't able to go into homes due to coronavirus and different pandemic era rules and regulations. That was to be expected. However, there was a 20% year over year average of an increase between September 2020 and February of 2021. So think about what that means for a second. In the early part of the pandemic, it basically dropped, had been level, and then dropped right after the pandemic, and then steadily rose right after the pandemic, and everything started to open back up until this point in time for where we are now. So if that's existing home sales, which now seem to be steadily increasing, let's talk about new home sales or new built homes. And those seem to have rebounded far quicker than existing home sales. Now, you can ask the question maybe why that is the case. There's probably a reason to point to and say it's because the fact that they're new home sales, they're vacant, people don't have a problem looking at them. But either way, those numbers rose more than 30% from June to February. So those increased faster than existing home sales. But for all of 2020 as a collective whole, existing home sales rose 5.6%, and new single-family homes jumped 20.4%. So think about that in terms of its context for where people are in terms of demand. On strengths of those gains alone, total home sales were at the highest level they've ever been since the housing boom in 2006. Now that facet alone is what has everybody so concerned. People are going to say housing hasn't been this great since 2006. That can't be good because then what happened after 2006? The great economic crisis and the housing foreclosure issue that everybody talks about and will still talk about for generations to come. However, that's maybe not necessarily a good thing and good kind of lump to make all together at one point in time. Home buying binge that occurred at that point in time occurred despite historically very tight supply. That's what we're talking about in this day and age. Inventories of existing homes were already very low heading into 2020. Forecasts estimate that we as a country lag behind our housing supply by about 1.5 million homes. That's a lot of homes over a period of time. The pandemic only made those situations worse and basically discouraging potential homeowners from thinking about putting their home on the market and being able to sell their home for a variety of different reasons. Where people are going to move to, should people be coming into your home to take a look at it? There are a variety of different reasons where people were perhaps a little, and rightly and justly so, a little bit apprehensive about potentially putting their home on the market. From March 2020 to March 2021, the existing home inventory shrank by about 30%, leaving just over 1 million homes available for sale. So think about that for a second. We were already lagging behind by about 1.5 million homes, and we only had 1 million homes for sale. That is not a good recipe moving forward. The month supply for homes, existing homes, which measures exactly how many homes are available at a given sales rate, for the first time ever in 2020, it dipped below 2 months nationally. So if every home on the market sold, we would have exhausted that month's inventory in less than 2 months as it followed its current sale ratio. That had never happened before. The median time on the market also hit an all-time record low on March 18th of last year. So think about those two things as we move forward here. The combination of robust demand and limited supply shifted and lifted home prices to their fastest pace in over a decade. The Case-Shiller Home Price Index, which is considered the gold standard for these types of things, rose 13.2% nationally in March of 2021, up 4.2% on average in the first quarter of 2020. So think about what that means over a period of time and what all that means over the course of a longer period of time and how that's going to play out moving forward. The FHFA Home Price Index shows an equal large year-over-year increase in the first quarter of 2021, with prices up double digits in 85 of the 100 large metro areas that it tracks. So again, we're talking about nationally here. We aren't talking about locally here. We'll touch on that in the coming days. But think about what all that's saying, that there aren't any real sections of the country that didn't have a great effect on the housing market in the last year where people were able to take advantage of these gains. So let's talk about now where we are in terms of housing inventory and what this means in the greater landscape as well. Single-family home construction starts hit 1 million units at a seasonally adjusted annual rate in August of 2020 and exceeded that pace through the first quarter of 2021. That's a promising sign. It means that home builders have a trust that the demand is certainly there. That's a pretty high rate. 1 million homes, that's good. If sustained, this would be the first year that single-family homes have topped 1 million since 2007. In 2007, home builders couldn't build homes fast enough to live up to the demand. But home builders right now feel comfortable and confident in being able to meet the demand that exists out in the marketplace right now, or otherwise they wouldn't be building the homes. To meet today's strong demand, still more existing single-family homes must come on the market. The widespread availability of COVID-19 vaccines and the resumption of more normal social interactions may in fact encourage more homeowners to sell. Still, with interest rates being so low and home sales being at such a furious pace, prices will likely to continue their ascent in the near term. This is where you folks all come into play. You can get out and talk to folks about what all this particularly means. People are going to feel more comfortable going in other people's houses. There's still opportunity for where people are going to go and what the next step is if they put their house on the market. You as agents and people in the housing market just have to figure out how best you want to be able to market and get out in front of these folks. All right? Home ownership. Let's talk about where we are at this point in time. The Census Bureau estimates that for the first quarter of 2021, we saw a less than 0.5% increase year over year in home ownership, which comes on the heels of an over 1% increase past the recession low in 2016 and 2019. So basically, fewer people bought homes. When we're also talking about home ownership, a fascinating level of detail to talk about is that younger households continue to lead the growth in home ownership rates with a just under 1 point rise year over year in the first quarter of this year. That means that younger folks are really looking to get into that home ownership level. If they're shedding their apartments, which we'll touch on in a second, and they're starting to really think about becoming homeowners. It's an important step to talk about and where this trend, which is only going to grow, and how all that's going to continue to move forward in the coming months and coming years as well. Rates for households under 35 were up 2.2% from 2016 to 2019, and that coincided with a 8% rise in real income among renters in this age group, meaning that folks who had in that age group under 35 had seen their incomes rise, and they thought about, do I really want to be still a renter, or now that I have seen my wages increase a percentage, do I think about now moving into the home ownership realm? This is an important question to have to ask and want to ask as we move forward here in the coming weeks and coming months and coming days as to what this trend is going to show. Rapidly rising home prices mean that upfront costs or home ownership are also increasing, particularly in markets where bidding wars are the norm. It's inherently to think about it as housing prices go up, costs of being able to buy that home are only going to rise as well. Simple math on that one. It's a direct relationship, in fact. Home price gains continue to outrun income growth last year, lifting the national price to income ratio to 4.4%, the highest level it's ever been since 2006. 2 decades ago, that ratio was less than 3 times income to 2/3 of the 100 largest metro areas in the country, and above 5 times income in only a handful of that market. So think about where that is shifting towards over the last couple of months, and think about in terms of where forecasted where that's to go. In 2020, the price to income ratio under 3 was in only 16 metros and above 5 in 23 of those metros. So we're definitely seeing an increase, especially in larger metropolitan markets like a Boston, Chicago, San Francisco, New York, Miami. So we're definitely going to see this trend continue over the next couple of years. That trend shows no sign of stopping. With housing prices representing such a large percentage of multiple incomes, accumulating the down payment and closing costs to buy a home could take years, particularly for younger households facing the twin burdens of high rents and significant student debt. So this is something that people have been talking about for the last couple of years, in particular when it comes to younger home ownership and people looking to buy homes younger than 35. This generation, or that generation, is certainly being saddled with large and vast amounts of student debt. And the question that so many people are asking for the last couple of years are how people going to be able to afford a home when they are saddled with thousands and thousands of dollars of student debt. That situation is only going to get more complicated as we move forward here over the course of time. All right, so that's the home ownership market. Let's talk about the rental market. Vacancy rates in prime urban neighborhoods, and Boston does count as a prime urban neighborhood, soared from 7.2% in the first quarter of 2020 to 10% in the fourth quarter of the same year, before edging just back down to below 10% to 9.6% in the first quarter of 2021. These are trends that everybody's been talking about. What is the eviction rate going to be? How many apartments are vacant over a span of a large period of time? In Boston, it was a huge issue as the students didn't come back to Boston as they were doing online schooling. So a lot of the student housing that is normally well filled up was not the case last year. So we'll certainly have to see where this trend is going to go. At the same time, vacancy rates in prime suburban areas also started out at 7.2% in early last year, but shrank to 6.3% at the end of 2020 and further to 6% in early 2021. So what is prime suburban markets? Well, suburban markets are what we were talking about last year when we were talking about urban flight. People were leaving the big cities and they were moving out into the metropolitan areas. They were moving out into the suburbs. They were fleeing those huge high-rise apartments buildings that you have seen so often in the bigger cities, and they were moving further and further out to potentially smaller buildings or single-family rentals. Those became highly prevalent and highly in demand in 2020 compared to the high-rise apartments that are so prevalent in large cities. Since so many higher quality rentals located in prime urban areas, vacancy rates in this segment rose from 10.1% in the first quarter of 2020 to 10.5% in the fourth, and just receded to just under 10 earlier this year. As a result, for higher end units, rents for those higher end units were down 1.9% year over year at the end of 2020 before recovering to a just under 1 point increase in the first quarter of 2021. That's simple supply and demand 101, folks. If there's not as much demand for those rents, well, people are going to lower their rents and provide subsidies and incentives to get people to try to move in. You go into downtown Boston, for example, many of the high-end luxury Class A buildings were offering 2, 3, 4 months free rent just to entice people to get in, to be able to move in, to make sure that their vacancy rates were high. The markets for moderate to low quality apartments remain tight with little change in vacancies over this period of time. Rent growth for moderate quality apartments eased from 2% to 1.5% in 2020, but then jumped way up to 3% in the first quarter of 21, and even faster pace than before the pandemic. In contrast, rent increases for lower quality apartments slowed from 2.3% in early 2020 to 1.8% in 2021. Now, you might ask, and this is where we'll just talk about locally here, rents in the first quarter of 2021 were down 8% in Boston. That is staggering. So if you're thinking about this in terms of demand, we're talking about Class C buildings having a lower demand than, say, a Class B building. Something that's not necessarily high-end, maybe doesn't have as many amenities, but still nice, not really a huge issue, probably kind of that middle-of-the-road rent, where people aren't necessarily looking for that higher-end building with all the amenities that are going to be a higher premium in terms of rent. But on the low scale as well, people weren't looking for those apartments either. They were looking for that stuff right there in the middle to really kind of ebb and flow that both supply and demand issue that might pop up. So let's finally talk about the housing foreclosure market before we get into our final outlook on what we're forecasting here in 2021. As of March 2021, the majority of the 7.1 million loans that had entered into the Forbearance program at the start of the pandemic had left that status. Of these loans, and you got to kind of take this as a bigger level here, 2/3 of those loans were again current, and another 1/5 of those were already paid off. Now I know 2/3 and a 1/5, that's two totally different fractions, but follow the math, try with me here, all right? A small share, 8% of those borrowers were still delinquent, but had engaged in some sort of loss mitigation with their lenders. 3% were delinquent and not working on a resolution at all. So take into account those things. So 2/3 of the mortgage loans that had been in the forbearance program were all current and out of the program altogether. 20% had completely either sold their property, paid it off, figured out, but had no loan left, so they're out of the program. 8% of the borrowers were still delinquent, but had engaged in some sort of loss mitigation or some sort of program to figure out a way to get out from underneath it, and their lender had moved on. 3%, the smallest percentage of that entire group, was still delinquent and basically said, I am not working on a resolution at all. So let's talk about those folks, for example, because the outcomes for those 2.3 million borrowers that are still in forbearance but have yet to resume their mortgage payments, those are going to be the people that we watch. So 2.3 million folks still needing some sort of resolution. Ginnie Mae, through the FHA program, just rolled out a brand new 40-year mortgage opportunity for people who are in forbearance to do a loan modification through. That is the first option that has been created coming out of these issues to create some sort of resolution for those folks. Now, it's a question how many of those folks are going to be able to partake in such a program, but time will certainly tell on that. However, there is still a situation that nobody else is talking about, and it gets more complicated when you talk about the accumulation of deficit that's come from not only just mortgage payments not being paid, but also property taxes, insurance, and on top of the fact, then you add in all the other outstanding debt that hasn't been paid. You're going to definitely see those values start to increase to the value of the home over the course of time. It's definitely a situation that does worth bearing repeating. Now, there are estimates of borrowers taking the full advantage of the 18 months forbearance that the program was designed to create. Some 22% would have less than 10% equity after factoring in all of those deficits that we just talked about, from insurance deficits, property tax deficits, mortgage insurance, all those different things accumulating up. 10%, less than 10% equity still in their home. The shares of the borrowers in this situation have their loans backed by the FHA and Veterans Administration are even higher at 36%. So meaning the government would be on the hook for over 36% of those mortgages should those continue not to move forward. So there's a huge potential thing to keep in mind here. And mortgage forbearance ends at the end of this month, at the end of the month of July. So there's only a limited amount of time left before things really kind of will hit its potential crescendo, so to speak, here in the 1st of August. So definitely be keeping an eye on that in the coming weeks here. Research for the Joint Center for Housing here in the actually in the Boston area over at Harvard shows that a quarter of the renters with COVID-related job losses reportedly that they had substantially depleted their savings, and another quarter had borrowed from family and friends, where 10% had turned to payday or personal loans. So it's really a shame that we're talking about people potentially going into more debt just to keep up and make sure that their housing is in place, whether they depleted their savings, went to family or friends, or in some cases went into more debt to be able to continue to pay their bills for housing. That's a real issue, and unfortunately there's no real remedy in place on how best to be able to figure out these things. So even let's assume that all those folks, that all those percentage that we just walked through, if they're able to regain their financial footing, these houses and these households will have fewer resources for which they can pull, whether it's some sort of everyday need or any sort of emergency that might come up, or definitely if they were even trying to save to make a down payment on a home in the coming future. The path and the financial freedom and the financial goal of being able to afford and buy a home and that dream of home ownership is becoming harder and harder for those folks who have certainly been disadvantaged by the COVID-19 pandemic. So where do we surmise all this? Where are we at this point forward? Given the extremely limited supply of homes for sale across the country, prices will likely continue to rise for the foreseeable future, even if it means that interest rates tick up and more sellers put their home on the market. But in the longer term, there is definitely robust growth in housing construction that will definitely be able to temper conditions in some of today's overheated home buying markets. And finally, home builders will need to meet the growing demand for homes of various sizes and at different price points, especially as millennials become the dominant force in the home market. We need to figure out a way where we can accommodate every single person and every single demographic in the home buying process moving forward, where we aren't just focusing on high-end and luxury homes. We also need to see mid-size and mid-price to low-end housing for everybody to be able to take advantage of in the coming days, coming weeks, coming months, and coming years as well. All right, so now let's take a look at a couple of quick graphs that are going to illustrate the point that we've kind of been making for the last couple of minutes here. The first one is going to show a couple of different things. Number one, it's going to show the rise of inventories. That rise of inventories is actually going to be that lighter blue line. The darker blue line is the month of supply that we were talking about a few moments ago, where you can see how that has progressed lower and lower and lower. Yes, there's been a couple of dips up here and there over the course of the last decade or so, but you can also see that the historic trend line there is moving down, whereas the year-over-year change in price has only gone up. The second graph, or the second table, however you want to call it, it's not really a graph, it's not really a table, it's a combination of the two, really tries to show the price to home income ratios in an increasing number of metro areas that are back to being the highest level. That chart line that you see going across the middle of the page, that's the US ratio. So that's kind of the average and median level. And really what you're seeing over the course of time is that you're seeing that that ratio is tending to skew not necessarily higher, but not necessarily lower either. It's kind of skewing almost in the dead center. Yes, there have been peaks. Yes, there have been valleys, especially when you look in the 05, 06, and 07 era. But for the most part, it does trend relatively consistent across the board on that front. So moving on to our third slide, you can kind of take a look at this graph, which is going to show in rather plain terms what the demographics and how different demographics in particular have been affected by the pandemic, both as renters and as homeowners. When you take a look at the more dark blue bar, that's going to be renters, and you can definitely see that unfortunately it definitely does skew in one direction. Homeowners, it's actually interesting that the data shows that they're really, with the exception of all non-whites, there really isn't a ton of differential in that equation between the Black, Hispanic, and Asian demographics compared to the white, where there is a remarkable difference in terms of how it is. But this is kind of what we are talking about here, and what the data has been bearing out over the period of time, that it has definitely affected non-whites more than it has affected white households, both as renters and as homeowners. And there's definitely some things that are going to have to be addressed, as this is a really unfortunate side effect in terms of the pandemic, how shares of households in terms of renting and homeownership, where they are behind in terms of their monthly housing payments. The next one is an issue that has come up several times over the last couple of months, but it's the rising lumber prices. And this is really kind of fascinating to see that the softwood lumber, which is the majority of lumber that's used for all home building, you can see how that has absolutely skyrocketed twice just in the last 3-4 years. Once just before, or right as the pandemic hit, then it kind of bottomed out, but then it's risen back up to those levels before. So everybody's talking about how lumber has actually gotten really expensive as of late, but in reality, it was actually at this point in time, not that long ago, it just didn't stay consistent over that period of time. And then finally, another one here to show as well, and that is the households behind on rent or mortgage payments often face other hardships as well. And this is something that we as a company have talked about, where if you're behind on your mortgage payment, you are more than likely behind in some other place in time or feeling some other struggle. That you can definitely see that people who are behind on mortgage payments also show high symptoms of anxiety, moderate to severe food insufficiency, meaning that they don't have enough food to live off of. They have fair or bad health. They didn't work due to COVID, and they don't have health insurance. So you can definitely see where the correlation is happening across the board on those different things, and what the causation of potentially being behind on your payment or being behind on a house payment has over the course of time as well. And then you could also see mortgage refinancing as well, how that has incredibly peaked just in the last couple of years, or last year or so really. You can see purchase originations lags way behind in terms of trillions of dollars, which is what the graph is. It's below $1.5 trillion in mortgage originations, but in refinancing, it's almost $2.5 trillion in mortgage in origination. So you can definitely see where that trend line is going. If you stack everything up over the last couple of years, those numbers don't even come close to being equal to where they are the last 3 years combined to where we were in 2020. So everybody's been talking about it. That graph shows it. And then finally, Fannie Mae is forecasting an 8% increase, and Freddie Mac, which historically has always been the more conservative or the most conservative of the group, is only forecasting a 6.6 for an average of 8.9% average of all forecasting. So we're just below a 9% increase in home price in 2021, or an appreciation of price in 2021, being 9%. That is historically high. Normally it's right around 6 to 7%. But right now we're looking at just over a 2% increase at 8.9%. So you can see where those averages, and historically forecasting higher across the board from some of the leading economic folks there. I hope you're able to get something out of this video. Hope you're able to get something out of the information here. Again, it's all about being able to serve your clients in the best way possible with the best information possible, and giving you the information that you can best serve yourself to be able to move forward and have the information that you need to educate your clients.